Well, hello there, everybody. Welcome to Always Off Brand special episode here. It is Amazon's 2025 Q1 earnings call. And for anybody who cares, all 42 of you, I missed Q4. I feel really shitty about that, and it pisses me off, but just had life things going on. Sorry about that. I really am, because I enjoy these immensely. So getting right into it, it was, May 1st, May Day, no May Day here. You've heard all the analysis, all the stuff. I'm going to kind of go through it in my way. And we're going to start off with, I think, just a change I noticed right away from the earnings call from yesterday. Just to set this up, before the call, if you don't listen to these calls, or there's the person comes on and has a bunch of disclaimers, right? Because they have all kinds of regulatory things to do. So he has to come on and say, hey, all the information here could be affected by all kinds of variables, all kinds of things. But I hadn't heard this. This is new, kids. This is a new one.
Economic and geopolitical conditions, tariff and trade policies, and customer demand and spending, including the impact of recessionary fears. That's
geopolitical commission. Maybe that's not new. Maybe I've just glanced over that. I usually just fast forward through this part, but this caught my ear. Tariff. There wasn't tariffs in these earning calls before. That's just unbelievable. Unbelievable. They now got to basically guard against tariffs, but the recessionary fears, the tariffs, all the other things, that's new. Okay. That is this just in breaking news. Oh God. Okay. Moving on. As I call Andy Jassy, Andrew, if you're not affiliate, Brian Osofsky, I call him BO. They're going to get into it here and talk about all kinds of the cool stuff. I mean, they got shit going on as usual. Here we go. Andy, or as I like to call him, Andrew, going to start us off here.
And now I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $155.7 billion in revenue, up 10% year over year, excluding the impact from foreign exchange rates. Operating income is $18.4 billion, up 20% year over year, and trailing 12-month free cash flow is $25.9 billion.
Okay, that's it. That's what 10%, more of the pie, 10% growth year over year in the first quarter. What? Yes, the bigger getting bigger. 20% operating margin increase. Are you kidding me? Holy sheboygan, Batman. Sign me up for a little of that, would you? Good night. That's just sick and wrong. That's cold-blooded, baby. Cold-blooded. Okay, Andy goes to the blah, blah, blah. We're happy of our stores. They call the stores. That's the seller central, vendor central. That's the retail component of it, the buying stuff. And then he launches this new one.
Saks, it offers a refined luxury assortment of fashion and beauty items from brands like Dolce & Gabbana, Balmain, Erdem, Giambattista Valli, and Jason Wu Collection.
Nice job on that, Andy. That's a tough one. Okay. Phonetically, they had to spell that out in the script for him, but that's a tough one. Nice job, Andrew. Yeah. But let's talk about Saks. Okay. You want my opinion on this? This is a Hail freaking Mary by Saks. This is unbelievable. Okay. If you would have told me 20 years ago, 10 years ago, 15 years ago, when I started working with these people, that Saks Fifth Avenue, the luxury of luxury, the hoity-toity, the bougie of the bougie, would be selling goods on Amazon. I noticed this the other day on my app. I turned the app on. I went to Amazon to go look at something, and I was hit in the face with the Saks Fifth Avenue. What? So that's where we are, okay? That is where we are. Just this is remarkable that you would have all these other major retailers basically throwing the white flag, in my opinion, and saying, you know what, we just can't do this. We got to go where the traffic is. We got to go where the growth is. Let's just freaking do it. Let's just, I can't take it anymore. We're losing everywhere. Let's just sign up. Let's walk down the aisle with the Amazon. All right. Unbelievable. Okay, so yeah, Saks Fifth Avenue. Then he gets into lowering the cost of sales. We're always trying to lower, make everything cheaper, and then
As
he hits
always,
you
we're
with
working to
this.
keep prices low. And with this being an uncertain moment for consumers, it's even more important than it typically is. In Q1, we held deal events worldwide to help
They
customers
held
save
deal
over
events. No
$500
one
million
really cares, Andy.
across the big spring sale in the U.S. and Canada, spring deal days in Europe, and Ramadan Eid sale events in Egypt, Saudi Arabia, Turkey, and the UAE.
And who pays for that, Andrew? Who pays for that? Saving money, you're just transferring it down. I've said this before. I love your lower cost of sales. It's basically a higher cost of doing business. That's what it should be. We're just, raising the cost of doing business. That's what the reality is. Your savings comes from somewhere. And the fulfillment network is the next thing he talks about that I have comment on. 4 days, by the way. 4 days on this Prime Day. This is public knowledge. 4 days. They haven't said the date specifically. They're already hawking every vendor and seller for money for marketing and advertising and doing deals out of your minds, because nobody knows, depending on the category, if you're gonna have goods, you're not gonna have goods. You got to can in early, so you're not tariffed, whatever. 4 days Prime Day, because again, they're at jeopardy here to say the best Prime Day ever. Well, if you just have it extended 2 more days, of course you're going to have the best Prime Day ever. I'm waiting for when's the next Prime Day after that. We're going to have an October thing. We're going to have this. Every month's going to be Prime Day.
Prime members will have more opportunities to save throughout the year, including at our 11th Prime Day event in July. Over the past few years, we've made significant progress in making our fulfillment network more efficient and cost-effective.
That is such bullshit, Andrew. You've made yourself low cost. We're paying out the ass your placement fees. We can't do full truckloads. That is just such a crock of shit from a seller and vendor standpoint. Freight costs are through the roof. I thought you had that covered. I thought you built your own company to move product. You're not losing UPS anymore. That just fires me up.
We've shared many times that an important turning point was regionalizing our national fulfillment network into regional hubs.
It's still not done. Still not fully cooked, peeps. Still not fully cooked and causing havoc.
By stocking items closer to where customers live, we're able to deliver more orders faster, often in fewer packages and at lower delivery costs.
Now, I got to give them credit, okay? I'm going to try to be fair. I did order 2 items recently on the same order, and it didn't ask me to do some special deal or blah, blah, blah to get it in one package. And there were 2 different manufacturers, 2 big brands, and it did come in one box. So you know what, Andrew? I'm going to give you some praise right there, okay? Nice job out of you guys. It's a complex zillion-dollar thing. They ship millions and millions. So you know what? I'll give you that one. That nice job out of you guys in the team, okay? See? I'm not all just rage and outrage. He then talks about, I'm going to fast forward here. He talks about these regional, they went from national to regional and these regional nodes. And then they're inbound. So how they get product in and then they move it to these different facilities. It wasn't set up for the regional, right? So it was still a 50-pound bag and a 10-pound hole. Let's just be honest. So now he's saying we've restructured and re-engineered all of that, which is great. But could you get going? I'm seeing that. I feel that. Not only do we have sometimes we have to wait for freight to get picked up and some other things. It's fine. I mean, overall, it's amazing. They do an incredible job. I'll give them that. So I'm gonna skip forward here and move on. And yes, operational investment and changes. We're all feeling them as vendors and sellers. The consumer, do they give a shit? No, they just want their stuff in the next 3 minutes. Okay, now it's tariff talk, kids. Andrew is going to come out with a little tariff talk, which is they've done research, right? So in all earnings calls, AI was mentioned like 44 times out of every single call or whatever. So tariffs obviously is the term of the season, earnings season. And here's Andy's is regarding his stores business, his retail business. Let's go, Andy.
I thought I'd share a few thoughts on the prospect of heightened tariffs on our stores business.
Prospect? It's happening, bro.
Obviously, none of us knows exactly where tariffs will settle or when. We haven't seen any attenuation of demand yet, to some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact.
I think we call it hoarding. And shout out the United States of America, because we're really good at hoarding. We proved that with COVID. Fear is the greatest marketing tool of all time. I mean, we are just buying shit because we're just scared it's not going to be there. And to some extent, probably should.
We also have not seen the average selling price of retail items appreciably go up yet.
No. What do you think this thing's made around the corner? I mean, that's the hope, but that's just not how this works. We haven't, yes, you had a big Q1, your dollars, you were up 10%, your margin was up huge. We're going to get to advertising. That was up huge, but come on, Andrew.
Some of this reflects some forward buying we did in our first party selling, and some of that reflects some advanced inbounding our third party sellers have done. But a fair amount of this is that most sellers just haven't changed pricing yet. Again, this could change depending on where tariffs settle. Amazon is not uniquely susceptible to tariffs. As it relates to China, retailers who aren't buying directly from China are typically buying from companies who themselves are buying from China, marking these items up, rebranding, and selling to U.S. consumers. These retailers are buying the product at a higher price than Chinese sellers selling directly to U.S. consumers in our marketplace, so the total tariff will be higher for these retailers than for China direct sellers.
Now, just to put a pin in there, Andy, if you could make sure that you tell everybody, this is in full disclosure, that over 50% of the sellers on Amazon in the United States marketplace are Chinese direct sellers. They're Chinese direct. Okay? Not to mention the other factor about, yes, the de minimis rule and everything else has changed for Shein and Temu. I know this is the Amazon earnings call, but remember, they don't have returns. So apparel and footwear, which is the biggest categories of those particular marketplaces, 30 to 35%, sometimes 40% return rate, they don't have. So just make sure you tick that off the line item. Back to you, Andy. I don't know that he understands how things are made and sold on his own platform. I mean, that's really probably stupid to say, but it just irritates me.
It's also sometimes easy to forget what Amazon sells. We're not mostly selling high average selling price items, though we certainly sell a bunch. In the first quarter, our everyday essentials grew more than twice as fast as the rest of our business and represented 1 out of every 3 units sold in the U.S. on Amazon.
Yeah, because let me just talk to the vendor community here. Yeah, this has been for a long time. This isn't new, right? The lower average selling price, the ASP that he's referring to, is essential goods, because you've become the CVS of everybody's lives, because they can get there in 5 minutes and I'm too lazy to go out. Yes, Andrew, that's of course you're the lowest thing. And that's also because the vendor side, the vendor central, the wholesale side, where the first party, they call it, is you're hammering the vendors for more money. And annual vendor negotiations were as tumultuous and conflicted and as I've ever remembered. It just keeps getting worse and worse because the margin pressure to put on it. God, we're only 6 minutes in here and I'm just fired up already.
Even if you exclude Whole Foods Market and Amazon Fresh, Amazon is one of the largest grocers in the U.S. with over $100 billion in gross sales last year. Still getting your ass kicked by Walmart, bro. Still getting your ass kicked. You've made some wins, tiny victories, still getting your ass kicked. Okay, we're going to move on because this is going to be a 7-hour episode if I go like this. All right, moving on. We're going to skip a bunch of stuff. I'll summarize it. Moving on to ads. And he is going to say a couple things about ads. I love how low key he is on the ads because it's the highest margin, fastest growing business. Moving to a few words on Amazon ads. We're working hard to be the best place for brands of all sizes to grow their business. We are pleased with the strong growth on a very large base, generating $13.9 billion of revenue in the quarter and growing 19% year over year. We're seeing strength across our broad portfolio of full funnel advertising offerings that help advertisers reach an average ad-supported audience of more than 275 million in the U.S. alone. Yeah, top of funnel, bottom of funnel. They've collapsed the funnel. Let's talk funnels. 19% growth, 13.9, almost $14 billion. Now, this will be interesting because they're pushing so hard on broad-based streaming TV, their NFL
their owned content, which I talk a lot about, which is driving up. Their revenue will be even increased on that end. I'm curious to see on the price per click on the PPC search side. Sponsored products has driven so much, huge volume for them, if we'll see any dip in that over the next 3 quarters. Talks about the next thing is about the owned content, right? He goes on for 25 minutes, no, actually probably about 10 minutes about AWS. Yes, AI, they're investing. Alexa Plus, everyone really loves it. Do they? He's rolling it out in the US. This is a huge deal for them. They got to get this right. They were so successful so fast originally, and honestly, they kind of need to put the rally caps on. But here he talks about ding 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 ding.
We're excited and honored to be part of the joint venture that will be creating the next generation of the esteemed James Bond film franchise. We recently named acclaimed producer Amy Pascal and David Heyman to produce the next James Bond movie.
He's really into it. You can hear that he's invested. He's done the research. He's Googled ChatGPT, AWS'd it, whatever he did. He really knows the director. I wonder if he's a fan. Is he a fan of the James Bond? Which Bond is his favorite Bond? I mean, I'd like to know that.
Additionally, just a couple days ago, Project Kuiper reached a significant milestone by launching our first satellites into orbit, with more being launched soon, and we expect to begin offering service to customers later this year.
This is unbelievable. He's going after Starlink. He's got more contracts. B.O. Brian in the Q3 earnings last year, I believe, said, hey, we were taking an operating expense hit because we got to build all these satellites in Kirkland. I wonder if they're going to do a collab. Is it Kirkland Signature?
I'm proud of what our teams around the world have delivered. We're excited about what we're inventing and working on as we speak. And with that, I'll turn it over to Brian for a financial update.
Thank you so much, Andrew. You did a great job. You're very proud. I'd like a little emotion out of you, to be honest. I mean, I know you're reading the script and it's been fine-tuned, but let's do a couple more table reads, okay? Let's just I need a little more from you, okay? Just some notes.
Thanks, Andy. I will begin with our top-line financial results. Worldwide revenue was $155.7 billion.
Okay, Brian, you're fantastic. I love your delivery. I'm going to move on. Okay, they made a shit pot of money. Their margin increased. They're doing fine. Margin. They're profitable as hell. Everything's good. They're launching new stuff. Blah, blah, blah. Let's skip forward. Okay, I'm going to quickly summarize Brian's portion of the program. He basically came on and said, you know what, we did great. Our operating margin could have been 70 to 90 basis points higher, but we had a massive return on some stuff. I don't really know the insides of that. Probably apparel and footwear, and they brought back a bunch of stuff. I don't really know. But also he said basically we pulled forward a bunch of first-party inventory in preparation for the tariffs, okay? So their operating margin took a little hit, okay? Took a little bobo, but I think they're going to be okay. I think their free cash flow is like $18 bazillion per quarter or something. I don't remember. The numbers, they got plenty of cash. They're doing fine. That's all you need to know. But that's the big call out. Obviously, the fulfillment structure and this and that and lowering cost to serve, blah, blah, who cares? Let's move on to the questions, which are part of my favorites. Oh, here's a shocker. Ross from Barclays with his first question, very first question of the earnings call.
Great. I think I'm going to leave the China questions to others and focus on AWS and kind of AI.
Unbelievable. These guys can't get off they can't get off the AWS. 17% increase year over year per quarter, 19% on the advertising, and they just can't stop themselves from asking about AWS. Okay, now we get to Eric's question. Eric from Goldman Sachs, and he lays it on the line. This is what got all the press, the post-earnings press.
Thanks so much for taking the question. Maybe I could ask a two-parter.
You're not supposed to do two-parters. It says one question. God, unbelievable.
First, in terms of strategy, Andy, how do you think about positioning the company for the medium term given all the levels of uncertainty out there about how the global trade environment might shift in the coming months? What do you see as the key strategic priorities that will allow the company to sort of be able to capitalize one way or another depending on various elements of outcome? And how do you prioritize those investments in the months ahead? And then with respect to the 1 quarter forward operating income guide, is there anything in there from a cost side that we should be thinking about as purely aligned with those types of investments against the trade landscape that might not repeat either later into this year or next year? Thanks so much.
I just want to give my boy Eric some props right there. That's a gotcha question right there. But the way he did it, the way he posed it was just outstanding. Way to couch it in a way that wasn't gotcha. All right, Andrew, this ain't his first rodeo, right? He's been in charge for quite a while now.
Thanks, Eric. It's hard to tell.
Oh, and by the way, if you think these people don't know what they're going to ask before they get asked, seriously, then I'm sorry. But yeah, they have all of this is completely prepared and scripted.
What's going to happen with tariffs right now? It's hard to tell where they're going to settle.
Oh, hard to tell? Really? Is it hard to tell? Is there any reason why it should be hard to tell? Why don't you call your boy Jeffrey, okay, and tell him to get on the line again? Apparently they're buddies, and say, knock it off. Stop it.
And when they're going to settle. And so a lot of what we're thinking about short and medium term actually turns out to be what we think about long term too.
How cute. Long term, short term. It's just the time continuum is something they don't. Why bother with it?
Which is, how do we actually have the broadest possible selection for customers at the lowest possible prices? And there's maybe never been a more important time in recent memory than trying to keep prices low, which we're heads down.
At whose expense is the question needs to be asked.
Pretty maniacally focused on, and then get things to people quickly and take care of customers.
Yeah, because we don't need slow, okay, Andrew? Don't get us to anything. When I order it, it better show up within 5 minutes. I skip past, right? In Q1, they ship the most goods in the fastest time around the world. Yay them. They have just, God, they are a contributor to lazy. They have just made us lazier and lazier. Thank you. And you're welcome, because it's all come at the expense of the vendors and the sellers and the people that supply you. You're welcome.
And that is the heart of what we're doing. And you can see different initiatives that we've taken within those priorities. We've done some forward buys of inventory where we're the first party seller.
Yeah.
Our third party sellers have pulled forward a number of items so that they have inventory here as well. And those are all, we're encouraging that because we're trying to keep prices as low as possible for customers.
Oh, Andrew. I don't know what to tell you, okay? Yes, you guys are going to win on this. You're going to win. Walmart's going to win. You're going to win. You're already injected into our daily consciousness and lives. You've made it so easy. You're going to win. The big are going to get bigger, and your cost of serve and how you keep everything as the lowest possible cost, because we are a discount palooza generation as far as the United States of America. We cannot get off the sale, and it's going to be deeper sales. And the interesting thing, again, he's not going to allude to this, but because nobody really knows, is how is the supply and demand going to work, right? Are we actually going to get supply, or is price so high and then we lose demand? Is the supply going to match it? Either way, they're going to be just fine. Okay? Don't worry about your boys and your ladies over at the big Amazon, the Ammy.
I think also when you have as broad selection as we have, and we have much broader selection than other retailers.
No, really? Okay. Skipping. Andrew gives all kinds of baloney, whatever. He says what he's going to say. You've read all of it about it. Have you seen it here? I mean, basically, we're going to just give the cheaper with selection, with this, with that. We're the bee's knees. Bye-bye. Okay, the other analyst asked about AWS, and then he dug into the Alexa Plus, and then Andy told a story about when he was in New York, and he wanted to find restaurants and pizzas, and he asked Alexa Plus, and Alexa Plus said, sure, here's the recommendations. Do you want me to do the reservations? What time? What day? All of these things, and Andy told the story, and it's very cute. Okay, next. Okay, I'm going to end it with Brian, my boy Brian Nowak from Morgan Stanley. He actually asked a pretty good question about trying to get a little bit into the fortune teller, into the crystal ball of Andrew. What is he thinking?
Thanks for taking my questions. Hey, Andy and Brian. So I have one for each of you guys. So, Andy, you have a very complicated retail business with a lot of moving pieces to it. I imagine you have a lot of good data on what you expect demand to be over the course of the year and the holidays and things. As you kind of step back and analyze the business and the tariff uncertainty, can you just sort of walk us through the one or two key areas operationally that you're most focused on just to ensure that Prime Day, Thanksgiving, and the holidays go as smoothly as they possibly can? And then secondly, on Brian, just to kind of go back to Eric's earlier question, as we think about the 2Q EBIT guide, are there any one-time costs or sort of tariff-related costs in there similar to that $1 billion that you called out in the first quarter? Thanks.
Thanks, Brian. On the retail question, I would say that the areas that maybe we're most focused on to make sure we have.
I'm at the edge of my seat, Andrew. I seriously. What's he going to pull out right now operationally? He loves talking about regional fulfillment, loves about inbound. Let's see what he hits us with.
Not just a great Prime Day, but Prime Day is just one event, as you know, and so is peak. We're trying to be great all year long for customers. The obvious ones are making sure that we help our sellers however we can, because there's uncertainty for our sellers as well. So we're trying to make sure we provide a great experience. We're trying to make sure that we have the right.
You think? Yeah, there's uncertainty. Good gracious. God, I thought I was Captain Obvious.
Diversity of sellers and low prices for our customers. I think all that, you have to also be very thoughtful around how much inventory you bring into your fulfillment nodes at any one time, because you can imagine scenarios where either on your own when you're the first party seller, or lots of third parties want to get as much inventory in as early as possible, trying to beat a deadline on what may happen. And if you end up with too much inventory in your fulfillment network, it really slows down.
Yeah, and then you're going to get nailed with massive storage fees. They're getting massive excess fees, massive other fees that are they don't want inventory sitting in their fulfillment centers. So that's great, Andrew. But then what do? I got a front load for tariffs. I got a front load for peak, but you're giving me no answers. I can't AWD myself out of it, Amazon warehouse and distribution out of it. You're not giving me that option, okay? And plus, that's not really working that awesome yet.
Your productivity and your ability to get things out as quickly as you want for customers at the cost structure you want. So being able to manage that thoughtfully, we've learned that over the years, and I think the team is doing a really good job.
So I was really waiting for a juicy insight here. I was waiting for something good, Andrew.
Job of balancing that right now.
And Brian, on your question about Q2, I guess I'll just reiterate what I had said earlier. We had stock-based comp step up, which I think you can see the normal pattern for that.
Okay, that's nothing. That was a nothing burger. Okay, basically, here's the deal. Q1 earnings report, all right? They had to write off like $1 billion because of tariffs pulling in all kinds of stuff. There was a huge return to it. Super duper hit their margins, but they were up 10% year over year, which is insane because remember, they're selling all low-cost stuff, number one. Number two, ad sales were through the freaking roof, okay? Almost 14 billion. AWS is $170 billion or something. I don't know. They're up 17%. The train keeps trucking. AI, agentic AI, and then Kuiper launched. That's a huge thing. They didn't really. I might have missed it. The Amazon Pharmacy, they are spending a ton on marketing Amazon Pharmacy. So basically, there you go. They did well. They kicked ass. They tried to basically manage expectations on guidance going forward, which is, they're always going to do that. And then it's going to be real interesting. When we get to Q3 analysis, that's where it's going to be real interesting. But I don't know what's going to happen. No matter what, they're going to be on the winning side, okay? Thanks for listening. People matter. Always Off Brand. Like it, subscribe. We have more great shows coming out. Hope you enjoyed this one. Take care. Bye-bye.
Hey there, this is Haley from Quickfire, and they want me to read this so you know what this podcast is part of and how to find out more if you want. Always Off Brand is a production of Quickfire LLC and a part of the Learn and Laugh series on the Quickfire Podcast Network. For more information, go to quickfirenow.com. Have a good one, and thanks for listening.